If you want to buy this pair of Adidas, you can use your credit card or a buy now, pay later service. The result seems similar. You don't pay up front, but with BNPL, you can break that full payment out into installments, usually with no interest. Buy now, pay later firms have boomed over the last 3 years. And companies like PayPal, Apple, and credit cards themselves are joining in on the hype. But as some of the companies scale up with their growing customer base, they're struggling to turn a profit. Here's how buy now, pay later services compare to credit cards and what it means for the next time you're checking out.
Everything today is pay as you go.
Dan Delev is an analyst who follows companies like Affirm, Block, and PayPal.
Credit is becoming a pay as you go thing, especially in very young millennial demographics.
Buy now, pay later companies took off in the US during the pandemic. Affirm, the only BNPL-focused company that's public in the US, reported its revenue more than doubled over the last 2 years. One of the main ways these companies make money is through merchant discount rates, a fee the retailer pays to the company on each buy now, pay later purchase.
Selling is better than not selling, and merchants are willing to accept somewhat of a discount in order to make the sale.
The number of retailers signed on to use Affirm jumped from just 6,000 in 2020 to 235,000 in 2022. Part of the reason for its popularity is that buy now, pay later is more accessible than a credit card.
BNPL is very attractive to people who have credit difficulties.
Todd Baker is a lecturer at Columbia Law School who has worked as an executive in finance and teaches about emerging fintech.
Other people do it just because it seems like a good idea.
Let's go back to that cart with our Adidas. With a credit card, you need approval to use that credit, often well before you put your shoes in the cart. Companies like Affirm, Klarna, and Afterpay, on the other hand, can approve on the spot and make approvals purchase by purchase. That's because of the different ways they check your credit. Credit card companies do a deep dive into your credit history that shows up on your credit score. Buy now, pay later companies typically perform a less formal credit check and look at additional data, like previous times you've used their service. BNPL can give more spending power to people who may not have access to credit or have credit built up, but that can be an issue.
There is a risk that credit will be extended to you in a situation where you're not likely to be able to repay, and that's not good either for the issuer of the credit or for the consumer.
Affirm's CEO Max Levchin says the company accounts for this.
We do have to say no and tell our consumers with love and compassion, you're overextending yourself, please don't buy this.
Klarna says it also takes measures to make sure it only extends loans to borrowers who can repay. Both Klarna and Afterpay restrict use of their services if a borrower misses a payment. Buy now, pay later lacks some of the regulated safeguards that credit cards have for consumers in the US. That's in part because they're not covered by the Truth in Lending Act. This is a law that requires that lenders provide you all of your loan information up front. No hidden costs. It applies to loans that are paid for in more than 4 installments. Buy now, pay later falls just below that.
The product was structured essentially to avoid the application of the Truth in Lending Act. The beauty of BNPL for the retailer is that it's instantaneous. And the provision of significant disclosure before a particular transaction would be very difficult.
Affirm says it provides a truth in lending disclosure for all credit extensions, and Klarna says it supports additional regulation of the sector. The Consumer Financial Protection Bureau also warns that consumers could risk overextension, meaning they have more debt than they can handle. This could happen because they could borrow from multiple lenders at once, since BNPL platforms can't see borrowing activity on other platforms. Customer defaults, when they happen, can have an impact on companies' costs, so they have to balance the risk of delinquencies with approving enough transactions to cover their costs.
That's the key to a successful buy now, pay later. It's underwriting, underwriting, underwriting.
Klarna said that its underwriting practices have helped keep its default rates below 1%. But delinquencies aren't the only thing that can undermine profits. Shifting consumer habits can cut down on transactions, and many buy now, pay later programs rely on funding that is sensitive to interest rates. Since merchant fees make up the bulk of their profit, companies might have to raise them to make up for higher borrowing costs.
If interest rates go up a lot, then they're in trouble because the cost of money is going to be too high to more than offset with the merchant discount rate.
Affirm and Klarna offer services beyond BNPL and are continuing to diversify their offerings. But they're also facing increasing competition from Apple, PayPal, and credit card installment plans. Still, for some buy now, pay later CEOs, like Affirm's Levchin, the competition is clear.
The enemy or the competitor is the credit cards, not each other.
Despite these challenges, Delev thinks that buy now, pay later is here to stay.
And as they become bigger and offer more services, they will be able to gain scale and increase profitability.
But some buy now, pay later firms, like Afterpay, have been bought by larger companies.
The fundamental question has always been, is BNPL a business or is it just a product for other providers of financial services? And I think the consensus seems to be shifting towards the idea that BNPL as a standalone business is not likely to be successful in the competitive market.